Okay, let's unpack this. For over a decade, Alibaba wasn't just another company. It was. It was really the single greatest symbol of China's whole technological rise.
The bellwether, absolutely. The one stock that seemed completely unstoppable.
Exactly. But today, the story is it's fundamentally different. Alibaba Group Holding, BABA, is standing at this profound crossroads. It's being hit by headwinds from, every direction.
It's a combination, right? Some of it is cyclical, tied to the economy.
Yeah.
But a lot of it is deeply structural. It's about competition. It's about technology.
So our mission today, as we dig into this financial research, is really to cut through all of that noise, the fear, the headlines.
And we figure out what's really going on. What is the actual financial health of this company?
Right.
What is its true intrinsic value? For you, the listener, the big question is BABA a generational buy hidden under all this fear?
Or is it a classic value trap, a stock that looks cheap for a very, very good reason?
Precisely. And the context here is this massive internal pivot they're trying to pull off.
It's not just a small change in direction. It feels like an existential shift in their entire corporate philosophy.
It really is a sea change. For years, the mantra was just unrestrained expansion.
Market share at all costs.
At all costs. Be everything to everyone. The new mandate under the returning leadership is laser-focused. It's capital efficiency, it's shareholder returns, and it's AI-driven differentiation.
But the timing could not be worse.
It's a perfect storm. You have a macroeconomic slowdown in China. You have this brutal competitive disruption from players like PDD and Douyin. And then you have the shadow of geopolitics hanging over everything.
Okay, before we dive into the numbers, we have to put up some guardrails. A quick but really essential disclaimer.
Yes, we need to be absolutely clear. Everything we're discussing today is based on publicly available information. It's for educational purposes only.
This does not in any way constitute investment advice.
Please, do your own due diligence. The market's volatile. This is a complex company. Talk to a professional before making any decisions.
All right, now that we've set that boundary, if you're interested in the bigger picture, the overall market mood.
Whether things are getting a bit too hot or too cold.
Exactly. We'd welcome you to search for and download the iOS app Buffett Indicator from the Apple App Store. It's a great little tool for tracking that total market temperature.
And if this kind of deep dive is what you're looking for and you want even more, you can always join our Deep Value Club. Or just find us on Apple and Spotify podcasts. Just search for Deep Value Investing.
Okay, let's start with the most recent report card, the latest earnings.
Right. For the quarter that ended December 34, 2024. They call it their fiscal Q3 2025.
And the top-line revenue number came in at, 280 billion RMB?
RMB 280,154 million, yeah. Which translates to roughly 38.38 billion US dollars.
A huge number. But the growth rate is what really tells the story here.
It was an 8% increase year over year. And that number, that 8%, it sends a very clear signal. Stabilization.
Stabilization, not hyper-growth. It's a world away from the 50 or 60% growth they used to post just a few years ago.
It's a seismic shift.
Yeah.
And you really have to contextualize that 8%. It's not happening in a vacuum.
Right. So what's holding it back?
Well, two big things. First is just the high base effect. When you're this big, growing at 50% is just mathematically impossible.
You've already saturated the market.
You've saturated the market. And second, and this is the more immediate pressure, is this trend of consumption downgrading across China. Consumers are they're hesitant.
They're not buying the high-margin luxury goods. They're looking for value.
Exactly. Moving away from the expensive brands toward cheaper, more practical stuff. So that 8% growth isn't about conquering new territory.
It's about defending the castle.
Perfectly put. They're defending their core business in a very tough environment.
Okay, this is where it gets tricky, because if you just glance at the headline profit number, you'd think everything is fantastic.
Oh yeah, the big splashy number. Net income was up. Wait for it. 333% year over year.
333%. So why isn't the stock soaring? Why aren't investors celebrating?
Because that number is, to put it mildly, distorted. It's almost entirely an accounting artifact. It's not a reflection of their core business performance.
What's distorting it?
It's overwhelmingly influenced by non-cash, mark-to-market valuations of all their equity investments, their venture portfolio.
So just to break that down, they own stakes in a bunch of other companies. If the value of those stakes goes up on paper,
Even if they haven't sold a single share.
accounting rules say they have to report that as income.
Exactly. It's an unrealized paper gain.
Yeah.
It's not cash from selling goods or cloud services, which is why any serious analyst immediately looks past that number.
And goes straight to adjusted EBITDA.
Correct. Adjusted earnings before interest, tax, and amortization.
Yeah.
You strip out all those weird non-cash distortions, and what you find is that the real barometer of their operational health,
Grew by a much more modest 4%.
a modest but, real and sustainable 4%. And that gap, 333% reported profit versus 4% operational profit, that tells you the entire story of the pivot.
It tells us they're not growing by just selling more stuff anymore.
No, the top line velocity is gone. They are squeezing out that profit growth through brutal operational efficiency, cost cutting, workforce reduction. They're optimizing the machine, not building a bigger one.
Let's drill down into the segments then, see where the bright spots are. Starting with the Bedrock, the Taobao and Tmall Group, or TTG.
Yeah, and TTG actually had a really positive signal this quarter. Customer management revenue, or CMR, was up 9%.
And that's the key metric, right? CMR is the high margin money. It's what merchants pay for ads and commissions.
It's the lifeblood of the platform.
Yeah.
And a 9% jump is crucial because it tells you that despite all the competition from PDD, merchants still see Tmall as the place to be.
The indispensable platform for brand building, for reaching those middle and upper income consumers.
They can't afford not to be there. That's the moat in action. So that's the defense. Now let's look at the offense.
Which is all happening internationally. Alibaba International Digital Commerce, ADC, grew a massive 32% year over year.
It's a fantastic growth number, but it comes with a huge asterisk.
Profitability.
Profitability. They're seeing widening losses in the international segment. That growth is being driven by the very aggressive rollout of the choice service on AliExpress.
Which is basically their answer to Temu and Shein, right?
Yeah.
A more managed, quality-controlled marketplace.
It is, and it's a very conscious strategic choice. Management is trading near-term profits for long-term market share in places like Europe and Middle East. It's a land grab.
An expensive one.
Very expensive.
Mm.
It requires huge investments in logistics and subsidies.
Okay, let's shift to the real long-term bet, the Cloud Intelligence Group. If there's one piece of genuinely bullish news here, this has to be it.
Without a doubt, the cloud business re-accelerated to 13% revenue growth. But more importantly, it was driven by triple-digit growth in their AI-related products.
For the 6th quarter in a row.
6 straight quarters of triple-digit AI growth. And the so what here is huge. It validates the entire thesis that Alibaba Cloud is successfully moving up the value chain.
From just selling basic infrastructure,
Which is a low-margin commoditized business they call IaaS, infrastructure as a service.
to selling high-value specialized AI services, PaaS, platform as a service.
Precisely.
Yeah.
It's the difference between selling raw computing power, like gasoline, and selling a highly optimized high-performance engine with a service contract. It's stickier, it's higher margin, and it's their key to future profitability.
So to really understand the investment case, you have to look beyond just one quarter and see the whole economic engine. It's not just a digital mall anymore.
No, the report frames it as a comprehensive digital utility.
And I like that framing. It's like they operate as a tax on the entire digital economy in China.
That's a great way to put it. They are the plumbing. A transaction happens, a package moves, a server is accessed, Alibaba is there taking a small slice.
And the revenue hierarchy shows that. China Commerce, TTG, is still the bedrock, 46% of revenue.
And that's the high-margin cash cow. Then you have cloud at about 10%, which is a strategic future. And Cainiao, the logistics arm, also around 10%.
Cainiao's model is interesting. It's not like FedEx or UPS.
Not traditionally, no. It's primarily a logistics data platform. It's asset light. It uses technology to orchestrate hundreds of thousands of local delivery partners. It's a much more capital-efficient model.
But this brings us back to that margin problem, the shift towards businesses where they own the inventory.
Right, the 1P or first-party retail. Businesses like Sun Art supermarkets.
Yeah.
This is the core reason for the overall gross margin compression.
Because selling physical goods, selling atoms, is just structurally less profitable than selling ads on a platform, selling pixels.
Exactly, and that margin reset is permanent. This is a fundamentally heavier, less profitable company than it was in 2016.
Which makes the economic moat more important than ever. Morningstar still gives them a wide moat rating. Why? If competition is so intense, where is the moat?
It's built on 3 pillars. But the most powerful one, the one that's still largely intact, is the network effect.
Millions of merchants, nearly 1 billion consumers.
It's a self-reinforcing loop. Merchants have to be there to reach the market. Consumers are there because all the merchants are there.
But let me push back on that. If the network effect is so strong, how did a company like Douyin manage to steal so much user time and attention? Doesn't that prove the moat has been breached?
That's an excellent question. I'd argue the moat hasn't been breached, but its surface area has definitely shrunk. Douyin attacked the discovery part of shopping.
The impulse bias.
Right, the things you didn't know you wanted. Alibaba's moat remains incredibly deep for intent-based shopping. If you know you need a new phone or a specific brand of detergent, you go to Taobao, not Douyin.
And all that high-intent search data just makes their own recommendation algorithms better?
It reinforces the whole system. So the second pillar is cost advantage.
Purely from scale.
Purely from scale. Lower shipping costs through Cainiao, lower payment processing costs, higher R&D efficiency in the cloud. And the third pillar is switching costs.
This one feels weaker for consumers who can switch apps easily.
It is, but it's incredibly high for their enterprise and merchant customers. Moving a massive cloud database or your entire Tmall brand store with all its history and reputation.
It's a nightmare. You're essentially locked in.
You're locked in. And even on the consumer side, there's a moat within the moat.
The 88 VIP program.
Exactly. With over 900 million users, the game isn't about getting new customers anymore, it's about share of wallet.
And these 88 VIP members, about 49 million of them, are the key.
They're the premium core, they pay a subscription, they have higher retention, and most importantly, they spend 3 to 4 times more than the average user. They are the margin protectors.
Okay, let's talk about how that moat is being tested, the headwinds. Starting with the short-term, cyclical ones.
The biggest one is just the sluggish macro environment in China, the big revenge spending boom that everyone expected after zero COVID.
It just never really happened.
It fizzled out. And the root cause is tied directly to the property sector,
where most household wealth is stored.
an estimated 70 to 80%.
Yeah.
So when that sector is in crisis, it creates this huge negative wealth effect. People feel poorer, they stop spending, and they start saving.
Which leads directly to that consumption downgrading we talked about, shifting from high-margin Tmall to low-cost Pinduoduo.
And that forces Alibaba into what the report calls a profit trough.
They have to spend money to defend their turf.
A lot of money. They're reinvesting profits into price subsidies, better logistics, better service, and that has a direct negative impact on free cash flow.
I think I saw a number on that. Didn't FCF drop by something like 70% in one quarter?
It did in the September 2024 quarter, a 70% year-over-year drop. That's the price of defense in this new environment.
And this isn't just a temporary battle. This is a permanent, competitive regime change.
A profound, permanent shift. Alibaba is no longer the default. It's one of 3 major players in a brutal oligopoly.
You've got PDD Holdings on one side.
Pinduoduo and Temu. They own the budget segment with a structurally lower cost model. They force Alibaba into a price war. It can't really win on margin.
And on the other side, you have ByteDance, Douyin, and TikTok.
And they attacked from a completely different angle. They pioneered interest-based commerce. They use content to create demand out of thin air.
They're not waiting for you to search. They're telling you what you want before you know it.
Exactly. And that attacks the very top of Taobao's sales funnel. It's a huge existential threat.
And then layered on top of all of that, the geopolitical risk, the one variable that's almost impossible to price.
It really is. And it hits them right where they're betting their future, AI and the cloud. The most direct impact is the U.S. export controls on advanced semiconductors.
The NVIDIA H100s and A100s, the chips you need to train the best AI models.
Right. And without consistent access to that state-of-the-art hardware, it is very, very difficult for Alibaba Cloud to compete at the frontier with AWS or Azure.
So it's not just a sales problem, it's a technology parity problem.
It is. It could create a permanent hardware disadvantage that erodes their biggest long-term growth engine. And that's not even mentioning the domestic regulatory risk, which, as we saw with the Ant IPO, can be unpredictable and swift.
So given all that pressure, they had to do something radical. They had to completely re-engineer the company from the inside out.
They had no choice. You can't just launch a new feature to solve these problems. It required a fundamental reset of their cost structure.
Which had ballooned over the years.
Massively. Yeah. Cost of revenue went up because of that shift to 1P retail and logistics. And sales and marketing spend went up because the free organic traffic is gone. They now have to pay to acquire and retain customers.
So if revenue growth is slow and margins are structurally lower, the only lever left to pull is efficiency.
A radical efficiency pivot. And the headline number here is just staggering.
The headcount reduction.
Total employees fell from a peak of around 254,000 in fiscal 2022 to just 124,320 by March 2025.
Wait, run that by me again? That's a reduction of nearly 39% in 2 years.
39% of the entire global workforce. This wasn't just trimming. This was a strategic amputation.
Who were they cutting?
Non-core businesses, failed expansions, and, critically, layers and layers of middle management that built up during the growth at all costs era.
And the financial outcome of that is huge.
It's the primary driver that's stabilizing their operating margins. That reduction in fixed labor costs is what's offsetting the gross margin compression. They are now ruthlessly focused on profit per employee.
And you can't do that without a major leadership overhaul.
This is the end of one era and the return of the founding generation. You have Joseph Tsai as chairman,
The capital allocator.
the sophisticated capital allocator. His job is to restore investor confidence, manage geopolitics, and oversee the massive capital return program, the buybacks and dividends.
And then Eddie Wu as CEO.
Eddie Wu is the product and tech guy. He's taken direct control of the two core units, TTG and cloud. His appointment signals that they see these as technology problems that need technology solutions.
His mantra is user-first, AI-driven.
That's the whole strategy in 4 words. Survive through efficiency, and then try to thrive again through superior technology.
Okay, let's connect all of that to the 10-year financials and see what it means for the company's actual value.
The decade-long view really tells the story of 2 different companies, the growth company and the mature value company.
Trend 1 is obvious. Revenue deceleration. We went from 50+% growth in 2017
to negative growth in 2023, and now it's stabilized in the low single digits. The hypergrowth story is over, period.
Trend 2 is that margin structural reset. Gross margins fell from, what, 66% in 2016?
66% down to the high 30s today. And this is the point that everyone needs to internalize. This is not a temporary dip.
That's permanent.
It's a permanent change in the physics of the business. They will never see 66% gross margins again.
But the source of truth for a value investor, through all this chaos, remains free cash flow.
And FCF has been remarkably consistent. They're a cash machine, generating over $20 billion a year. But, and this is it has plateaued. It hasn't grown in 5 years. They're running harder just to stay in the same place.
So let's put it through the Buffett-style checklist. Where does it pass and where does it fail?
Okay, the passes are what make it a deep value play. First, the PE ratio is often between 9 and 12. That's a huge pass compared to its history.
Second, the balance sheet.
A fortress, massive net cash position, very little debt, a clear pass on safety. And third, FCF positive, another pass.
So cheap valuation, safe balance sheet, and it's a cash machine. Why is it so cheap? What are the fails?
The fails are why the market hates it. First, predictability. The earnings history is a roller coaster. It's not the smooth, predictable staircase Buffett loves. That's a fail.
Return on equity.
It's fallen into the 10–12% range. It's okay, but it's not great. So a fail. And it's dragged down by that huge pile of idle cash on the balance sheet.
And the biggest blemish of all.
Return on retained earnings. For years, management took all that cash flow and poured it into value-destroying acquisitions like Euchre. That is a massive historical fail. The new buyback plan is basically an admission of that failure.
So the verdict is clear. It's not a high-quality compounder.
No, it's a classic deep value play. It is cheap for good reasons. The question is it too cheap?
To try and answer that, let's look at a discounted cash flow model. The assumptions here are key. We're using a WACC, a discount rate of 10.5%.
Which is high. A typical U.S. large cap might be 8%. We're adding a big risk premium for all the China-specific uncertainty. We are penalizing the valuation up front.
And we're factoring in about $60 billion in net cash.
Which adds a big chunk of value right off the top.
Okay, scenario 1, the conservative bear case. This assumes things stay bad or get worse.
We assume free cash flow stays flat at about $20.8 billion for 5 years and then actually starts to decline forever. A slow, managed death.
And even under those brutal pessimistic assumptions, what's the intrinsic value?
The DCF spits out a value of about $111 per share. If you want a 25% margin of safety, your buy price is around $83.
Okay, now the base case. This assumes the efficiency pivot works and they stabilize.
We assume a modest 3% FCF growth for 5 years, basically tracking GDP and then 2% terminal growth. Very reasonable assumptions.
And that puts the intrinsic value at
about $145 per share, which gives you a target buy price with a safety margin of $109.
So the huge takeaway here is that with the stock often trading between $75 and $90, it's below even the most pessimistic, conservative estimate of its value.
Exactly. The market isn't just pricing in no growth. It's pricing in a permanent, rapid decline that seems frankly, overly pessimistic given their cash pile and market position.
It creates that asymmetric risk-reward profile.
It does. The potential upside, if they just manage to stabilize the business, seems to be significantly larger than the potential downside from here.
This deep undervaluation has made the stock a battleground for famous investors. But first, there's a huge structural change that's happened quietly.
The removal of the supply overhang. This is so important. SoftBank, which was once the largest shareholder, has been selling down its massive stake for years.
That acts like a ceiling on the stock price, right?
Giant invisible ceiling. No one wants to be a big buyer when they know the biggest owner is a forced seller. Now that pressure is largely gone.
And management is stepping into that void. They're not selling. The company is buying.
Aggressively. They become a cannibal stock. They have a massive $25 billion buyback program, and they're executing it.
And critically, they're buying back shares faster than they're issuing them for employee compensation.
Which means the actual share count is shrinking. And in a low-growth world, shrinking the share count is one of the only ways to grow your earnings per share.
Plus, they started paying a dividend.
The ultimate sign of maturation. They're signaling to the market, we are a stable cash cow utility now.
This brings us to the great investor divide. On one side, you have the late Charlie Munger.
Munger famously bought a huge position, averaged down, and then sold half at a big loss. He admitted he completely underestimated how brutal the competition was in Chinese retail.
He called it one of his worst mistakes, a powerful admission.
It is. He saw the value, but he misjudged the competitive threat. But on the other side, you have Michael Burry of The Big Short fame.
Who has been trading it, but recently made it his single largest position.
Exactly. Burry isn't betting on a return to hypergrowth. He is making a purely mathematical bet on extreme undervaluation, that the discount has just gone too far.
So you have Munger selling because of the competition and Burry buying because of the cheapness despite the competition. It perfectly captures the debate.
It really does.
So when we pull this all together, what's the final synthesis from this deep dive?
I think what stands out is that the margin compression is real and it's permanent. The hyper-profitable Alibaba of 2016 is never coming back. But the operational efficiency pivot, that radical headcount reduction, is also real. And the growth story in AI cloud is credible. Those are tangible paths to unlocking the value that's trapped by all this fear. The balance sheet gives them the time and the resources to do it.
It's a giant trying to reinvent itself in the middle of a storm, which leads us to our final provocative thought for you to take away from this.
Can it conglomerate this massive, really pivot its entire culture? Can it shrink by nearly 40% and at the same time spark a whole new growth cycle in high-tech AI?
Or is the market right to fear the geopolitical risk and the relentless competition above all else?
And the answer to that really comes down to your own analysis of those risks versus the very tangible, deeply discounted value we've outlined today. And remember, this is all for educational purposes.
Please, do your own due diligence. And as a reminder, if you want to track that broader market temperature, you can search for and download the iOS app Buffett Indicator from the Apple App Store.
And for more of these deep dives, be sure to join the Deep Value Club or subscribe to the Deep Value Investing podcast on Apple or Spotify.
Thank you for joining us on this deep dive into the Alibaba crossroads. We'll see you on the next one.